Hello everyone. Today I am going to talk about the most common and essential sector of the Indian economy, FMCG, fast moving consumer goods. This sector is considered as a barometer of consumer demand in the economy. It is the fourth largest sector of our economy and is divided into three main categories: food and beverages, healthcare, household and personal care, consisting of 19%, 31% and 50% respectively. Household and personal care accounts for the largest share in the sector due to growing awareness about personal care and hygiene among consumers. Easier access and changing lifestyles have also contributed to the growing demand for this segment. Urban sales contribute around 55% to revenues of FMCG companies and 45% is contributed by the rural segment. However, demand for quality goods and services have been going up, especially in rural areas of India, on the back of improved distribution channels of manufacturing companies and the recent shutdowns which caused hoarding of essential goods in fear of timely supplies. Semi-urban and rural segments are growing at a rapid pace and FMCG products account for 50% of total rural spending. The rural FMCG market in India is expected to grow to $220 billion by 2025 from mere $23.6 billion in FY18. Before moving on to some specific fundamental factors which you as an investor would need to check out before buying FMCG stocks, I would like to explain some common parameters which are equally important before selecting a good FMCG company. Diversity in product portfolio. It is important to identify the product mix of a FMCG company as it determines the various categories the player is operating in. A company present in toothpaste, soaps and detergents tend to have relatively stable sales as these are essentials in day-to-day life, whereas companies present in discretionary segments such as perfumes, cosmetics, etc. often report declining sales during the times of recession like the one we are facing now due to COVID-19 lockdowns. You should always prefer companies having a diversified product mix catering to different needs and with a higher focus on essential categories. Although presence in one or two niche categories where competition is fairly low can strengthen its market position as it can be a price setter. Brand equity and market share. A company which is successful in gaining higher market share has several advantages. It ensures a stable relationship and long-drawn contracts with distributors. If a company has higher market share in a product, it does not need to offer very high discounts, since this gets compensated for by the higher volumes. So find a company which has a higher market share in one or two product categories. For example, Nestle, which has 96% market share in infant cereal segment, which consists of 46% of its total revenues. If brand equity and loyalty is strong, consumers tend to be willing to pay a high price for the product and will be reluctant to switch to other competing brands. Other than these two factors, an FMCG company needs to have a robust supply chain and wide distribution network to reach its customers. Now let's move on to some specific fundamentals of FMCG companies. First up is top and bottom line growth. Sales of FMCG companies are driven by volumes and a diversified portfolio. Here we are going to see 5 years and 3 years sales and profit growth of these companies. You should note that higher sales growth, if managed well, tend to translate to the bottom line. This is quite evident from these FMCG stocks. These stocks are present in our model portfolio and almost every company has reported healthy 3 and 5 year sales CAGR growth. Their operating efficiencies have led to robust PAT figures as well. Looking at the Nestle's example, it has recorded highest sales growth in CY19 of 9.5%, largely outperforming its peers. It has a diversified revenue profile with 47% of its revenue generated by milk and nutrition products and 29% from ready-to-made products. The diversified revenue profile mitigates risk. For example, despite facing Maggi ban crisis, Nestle has reported healthy 5-year sales and PAT CAGR growth of 4.7% and 10.7% due to its diversified portfolio. Now let's understand volume and sales mix. For a FMCG company, volume is the key factor leading to sales growth. Here we have taken Nestle's last 5 years volume mix to understand how its segmental volumes have evolved and grown. Way back in 2015, Nestle's highest volumes used to come from milk products, contributing 45.5% of its sales in CY15. But now, if you see, its ready-to-make product dishes category has grown significantly with the highest volumes of 55% in CY19. But the milk product category still contributes around 46% of Nestle's sales compared to 55% in CY15, mainly because of having 96% market share in infant cereal categories. So, it is important to maintain a steady volume mix and market share in at least one or two categories, which helps the FMCG company maintain its volume and sales mix. So, it is important to maintain a steady volume mix and market share in at least one or two categories, which helps an FMCG company maintain its volumes and sales mix. Turning over to some important return ratios. Among various return ratios, there are two important ratios you must check as shareholders: return on equity and return on capital employed. Return on equity is a ratio that measures the profitability of the business, and return on capital employed shows the profits a company can generate given the amount of capital used. Both these ratios are extremely essential to see consistency in returns to shareholders over the years. HUL and Nestle are the FMCG giants with highest sales and highest market cap in the sector. HUL has been maintaining average ROE and ROCE of 80% and 112% respectively in the last 5 years, and is also currently giving above average returns. If you see, all the companies in our portfolio are giving similar kind of returns. Moving on to the valuation metrics of FMCG companies. Price earnings versus industry price earnings. The price to earning ratio is one of the most widely used tools for selection of stocks. It looks at the relationship between a company's stock price and its earnings, which basically gives us an idea what market is willing to pay for the company given its earnings growth. In the FMCG sector, you will usually see companies trading at high multiples, as this sector is considered as a defensive play in the economy. It is the least affected sector during slowdowns. Nestle and HUL are trading at premium valuations due to their strong foothold in the market, while companies like Britannia, ITC and Godrej Consumer are currently trading at attractive valuations. Finally, let's look at what are the risk factors which could impact the growth of the FMCG companies. One of the biggest risks for any business right now is escalation of the pandemic and future lockdowns. But for the FMCG sector, it could be largely a boon, as the changing consumer behavior towards hygiene and home cooked food vis-a-vis ordering outside meals or visiting restaurants will force companies to re-strategize their business plans by focusing more on rejigging their portfolio. The composition of the consumption basket has changed due to COVID. Some of these changes will be more important than players. An increased focus on health and hygiene will become the new norm. Demand in the discretionary categories is likely to come back slowly but not immediately. Largely, demand in the rural segment was comparatively better than urban areas due to the lower impact of the pandemic in rural areas. However, this may not sustain if the pandemic starts spreading in those areas rapidly. Most of the FMCG companies are relying on rural consumption, and if this happens, it would hit their demand outlook very badly. The Indian FMCG industry has both organized and unorganized players across segments and products. All the FMCG companies face stiff competition across categories, and with the entry of new players, including multinationals, in segments such as soaps, detergents, personal care products, etc., competition risk will be higher. For product segment, depending on commodities like oil, cereals and crude oil, efficient raw material management becomes a crucial factor, especially in segments where operating margins are thin and competitive intensity is high, such as edible oils and soap. Risk pertaining to raw material price volatility as well as supplier concentration are important to analyze. An entity with a wider supply base might have better negotiating power with suppliers, which can mitigate supplier concentration risk to an extent. Thank you, and I hope this video helps you select the right FMCG stocks for your portfolio.